Hello everyone, Sylvester once again, a man of his caliber. I think you know me by now. I just want us to go through a section which is very much important, a section which consists of many marks. So that section is called closing transfer. Some books call it final accounts, some books call it the financial year end adjustment. Okay, so we will focus on the closing transfer. Firstly, let's try to understand what do we mean by saying closing transfer. Remember, as an entity or a business, we start our period from the beginning of the period, obviously, to the end. So at the end of the period is where we compile financial statements. But those financial statements can only be by using the final accounts. So meaning all the balances which I have at the end of the period will be used to compile financial statements. In a nutshell, the closing transfer focuses on the final accounts. So we're going to close off those accounts. Thereafter, we can prepare the financial statements. Without wasting time, let's go to the next slide. Guys, this is my email address. If you have got anything to ask, you can use this email address, and I'll try by all means to make sure that I come back to you as soon as I can. Now, as you can see here on my slide, I've got two main accounts. These are the accounts which you will find in the exam. So make sure that you master this account so that by the time when they ask this, you can be able to answer them. Okay. Firstly, let's focus on the trading account. A trading account is an account that is used to calculate either gross profit or gross loss. Remember, sometimes we make gross profit and sometimes we make what? Gross loss. The question is, why do we call that gross loss or gross profit? This means we still have to deduct other expenses and we still have to add other incomes. It's like your pay slip. You have got the gross salary and you have got the net salary. So gross means before deduction. The same applies to the entities. So gross profit, it means before expenses are deducted. Okay, so we need to make sure that we understand this. Firstly, let's focus on the trading account. A trading account consists of the following items. If you are under perpetual inventory system, you will have to transfer sales and cost of sales. Okay, now let me focus on the sales for now. The sales need to be adjusted. Remember, sometimes we sell goods and our customers can decide to return those goods. We call that debtors, allowances, or sometimes you can call it sales return. So the sales returns must be deducted from the sales, but I'll still have to go into detail when it comes to the next slide. Okay. Again, the cost of sales needs to be transferred to the trading account. So in a nutshell, in the trading account, we transfer sales and cost of sales. But the challenge can be where we use periodic inventory system. This will mean that the cost of sales will not be given to you. Instead, they will give you the items which will be used to calculate cost of sales. Remember from our past experiences, if the cost of sales is not given, especially under periodic system, we have got a formula where we calculate that cost of sales. We normally say the opening inventory, we add net purchases, we add any carriage on purchases, and we add any other related items to purchases, and thereafter we less what? Closing stock. So if they give you those items, it means you have to transfer them to the trading account one by one, meaning opening inventory, transfer to the trading account, closing inventory, transfer to the trading account, etc., etc. Now, let's talk about the profit and loss account. A profit and loss account is an account where we determine whether we make profit, meaning net profit or net loss. Remember, trading account, gross profit or gross loss. Profit and loss, net profit or net loss. So we record all the other incomes and all the other expenses. Why do we say other incomes? It's because sales are also incomes, but we still have the other incomes other than sales, like rent incomes, commission incomes, etc., etc. The same applies to other expenses. Why do we say other expenses? Because the main expense is the cost of sales. The other expenses can be what? Telephone, advertising, salaries, etc. So we need to make sure that we know the items to record in the profit and loss account. Okay, I hope at the moment we are getting the point. Now, let me go to the next slide. I tried to give you some flow here. Remember, I said firstly, we start with the trading account to calculate whether we made gross profit or gross loss, and thereafter we go to the the profit and loss, and check if we made net profit or net loss. So there's a flow, and we must know how to interrelate or link these processes. Firstly, you need to make sure that, as you can see here, we need to make sure that we find our sales from the list of balances, and thereafter we need to less sales returns if we have any, and thereafter we need to less the settlement discount granted if they are given to us, and thereafter we add or less allowances for settlement discount granted adjustment. Okay, so this is a very special case, guys. We need to know that how to deal with this one. Okay, so we must make sure that we check this formula: sales less sales returns less settlement discount granted plus or minus allowances for settlement discount granted adjustment. And thereafter, the amount that you get will be called net sales. And that net sales must be transferred to the trading account on the credit side. I hope you are following. Now, let's switch over to the next slide. Remember, I said sometimes you can find that we are using perpetual and sometimes we're using periodic. So now, here we are going to focus on what? On the cost of sales now. So meaning, remember, cost of sales must be part of the trading account. So we need to also transfer the cost of sales to the trading account, as you can see here. This is my cost of sales. So we need to make sure that we take cost of sales, we less any settlement discount granted, discount received. Sorry, not granted. So that discount received need to be deducted from the cost of sales before we transfer the cost of sales to the trading account. And remember that cost of sales must be transferred to the debit side of what? Of the trading account. Remember, on the credit side you've got sales, and on the debit side you've got what? Cost of sales. But this is under what? The perpetual system. Okay, you can see here I wrote if we are under perpetual system. Remember, I said under perpetual inventory system is where they give you cost of sales. The question is, what about where we are under the periodic system? Remember, the cost of sales in those circumstances won't be given. This is how we are gonna transfer the information. You will be given the opening in trading inventory. You will be given purchases. I said adjusted. You will be given carriage on purchases. You will be given custom duties. So all these items which I mentioned here must be transferred to the debit side of what? Of the trading account. Remember, this is only when you are under periodic system and they did not give you cost of sales. So you will transfer those individual accounts one by one to the trading account. Now, when using the periodic inventory system, obviously, as I said, you'll be given the closing trading inventory. Again, the closing trading inventory will be transferred to what? To the trading account on the credit side. Okay, remember the other items will be on the debit side and the closing inventory will be on the credit side. Okay. Now, because now we've got the sales on the credit side and the cost of sales on the debit side, depending on the system of inventory, now we need to balance the trading account. Remember, we need to compare the credit and the debit. Like I said here, if the credit side is more than the debit side, it means we made gross profit. Okay, so that gross profit must be transferred to what? To the profit and loss on the credit side. Remember, the gross profit is also an income. Under the profit and loss, all the incomes must be on the credit side and all the expenses must be on the debit side. So the gross profit will always be under the profit and loss, under what? Under which side? On the credit side, because it's also an income. But what about is the situation where we made a loss? Like in this case, where we made a loss, as you can see, we still have to transfer to the profit and loss, but under the debit side. But why under the debit side? Is because under the profit and loss, on the debit side is where we put what? Expenses. And gross loss is an expense to the business. So it must be part of what? Other expenses. I hope we are following here. Now, let's say, for example, after balancing, we get gross profit, like I put here in brackets here. Meaning this gross profit is part of the incomes. That's why you can see here, I even said other incomes now. So the gross profit and other incomes will always appear on the credit side of what? Of the profit and loss. So make sure that you know that on the credit side, we put all the income. So we made gross profit, we put it on the credit side. Other incomes will join the gross profit. Okay. Now, what about if we made gross loss? So gross loss, as I said, is an expense to us, so it must be part of other expenses. So on the debit side, we need to go and record the trading account in the form of loss and other expenses. Okay, so this thing will make sense by the time when we start recording in physically in the books of account. So for now, I'm just trying to give you the theory around this. Okay. Now, balancing the profit and loss account. Again, remember we were focusing on the trading account. Now we are focusing on the profit and loss account. Remember, if the credit side is more than the debit side, this will mean that we made a profit, which is the net profit. And the net profit is always transferred to the capital account on the credit side. Remember, capital is an owner's equity. All the equities increase on the credit side. But sometimes we make losses. So if our debit side is more than the credit side, this will mean that we made a loss. And again, this loss will affect capital, but it will have to decrease capital. That's why we must go to the debit side of what? Of capital. Remember, this is when you are balancing the profit and loss account. Now, after balancing that particular profit and loss account, remember we either get net profit or net loss. It means we need to make sure that we go and transfer that amount to the capital. So under capital, this is information is all about capital. On the you need to transfer balance brought down and the profit and loss only if you made a net profit under which side? On the credit side. It's like what I said from the previous slide. Okay, so meaning if you made a net profit, the net profit will always increase capital account on the credit side. Unlike net loss will decrease what? The capital. So make sure that you know whether you made a loss or you made what? A profit, because the losses must go to the debit side and the profit must go to the credit side. Thereafter, you need to go and look for any drawings that you have. Okay, so drawings, again, remember they are negative owner's equity. So they affect capital, and drawings must affect capital negatively. Then that's why we put what? Capital, the drawings under which side of capital? On the debit side, to show that we are decreasing what? The capital. Okay, so we need to make sure that we understand this. So these things are interrelated. For example, we say sales less cost of sales, and the whole process of sales of saying sales less cost of sales is done under what? Trading account. So it's either you get gross profit or gross loss. That gross profit or gross loss must be transferred to what? Profit and loss. Remember? So if you made a gross profit, that amount will appear under what? the profit and loss under the credit side if you made a gross profit. But don't write gross profit. You write what? Trading account. You can write trading account in brackets what? Gross profit. Don't just write gross profit because you can't open gross profit account. We open trading account. Now, on the credit side of that profit and loss, you will also see any other incomes. Let's say rent incomes, commission incomes, any incomes received by what? By the company will appear on the credit side. On the debit side, you will see other expenses like telephone, advertising, salaries, wages, etc., etc. Thereafter, you balance that profit and loss. The difference is either net loss or net profit. We only have net profit if our credit side of the profit and loss is more than the debit side of the profit and loss. But if the debit side of the profit and loss is more than the credit side of the profit and loss, we will make what? Net loss. And that net loss is taken to what? To capital account. That's why when you balance it, you don't just write net loss only. You must write capital in brackets net loss, and you transfer to what? To the capital account. When you deal with the capital account, like I said, on the credit side, you will have a balance of the capital. If you made a net profit, you will see that net profit under what? Under the credit side in the form of profit and loss. And you must not forget to put drawings on the debit side, and thereafter you balance this account. I hope these basics are important. You get them important. So make sure that you understand what's going on, guys. Thank you very much for that. Hopefully this is gonna be useful to you guys. Thank you.